Hi, everyone. I'm Rick Bensignor. Today is Tuesday, October 12th, and welcome to this week's In the Know Trader show on StockCharts. Today, we're going to look at, in our trader education portion, why trade commodities. And we'll talk about pros and cons, and then spend a fair amount of the show looking at commodity markets. In market overview, we'll take a look at the Dow, the US 10-year, and the Goldman Sachs Commodity Index ETF, GSG. And then we'll look at a dozen or so or more specific commodity markets and take a look at what the charts say about them. Just to get through some house cleaning as we do each week. My weekly ETF Tactical Trader Report generally comes out Thursday nights, comes out once a week, and reviews macro markets far more extensively than we do in the show, especially concentrating on the S&P, which we don't do in the show. That is for clients. And then we give you a new ETF trading idea each week and review all open positions that we have until they get closed out. We also publish a report called the 7-11 report. It comes out monthly on the last day of each month. Its goal is to outperform the S&P, which it has continuously done. In the first year, we outperformed by 2.61%. This year, we're already up. I think we're up close to 1% outperformance already in the early going of year number 2. And again, to get information on that, go to inthenowtrader.com or send me an email, rick@inthenowtrader.com, and I'll get you started on that and any questions you have. And then just very quickly, let's take a look at the macro sector relative results. Of course, energy continues to be the biggest outperformer this year. Well, it's up almost 54% versus the S&P 17%. So it's about a 37% outperformer this year. Financial is number 2 at 33%. So that's about a 16% outperformer. In mid-July, I think it was. Yep, mid-July, I raised financials to a full outperform. And go, full overweight energy, and went to full overweight in mid-August on the exact, in fact, both of those were on the exact bottoms of their pullbacks. And since then, we have outperformed the S&P by 26.5% in those two sectors. So, it does come down to timing often, and that is what we do, and that's why the 7-11 report continues to outperform the S&P, is we know when and where to play the sectors. All right, let's go back and just start things off with why trade commodities. Well, first off, I'll tell you, if you trade commodity futures or thinking about it, you really need to kind of read up on them and understand what you're getting yourself into, because these are not your typical type investments like stocks or bonds are. Commodities are much more volatile. If you're trading futures, you are putting up generally in the neighborhoods of 5% of the actual value of the contract. So a 1% move is already a 20% differential, either up or down, on the money that you put up. So these are highly, highly leveraged instruments that can make you a lot of money or lose you a lot of money very quickly. So you do not generally invest in commodities, you trade them. And if you're not a trader, then I'd say stay away from them, because generally the money movement is fast enough that you're either made enough or lost enough quickly that you're in and out in a much faster fashion than you are when you invest in something. Commodities are generally considered a non-correlated asset class, so they don't necessarily move in the same direction as stocks or bonds. And therefore, if you are educated enough to trade them, then they can help diversify a portfolio. because in general, let's say the price of sugar or cocoa or cotton or natural gas really have nothing to do with the direction of the stock market or the bond market in general. And therefore you get some type of diversification. So some people would say, just like you always want to own a little piece of gold, which of course is part of the commodities markets. So a little piece of gold, meaning in your whole portfolio, you want to have some gold as a diversification strategy. You could have, a basket of commodities in there that each one kind of moves themselves, but in general, commodities tend to move in the same direction during different phases of economic growth and contraction. So you get some type of diversification in them. And because of the onset of ETFs, some that track individual commodities, but some, for instance, the GSG, which tracks a commodity index, it gives you a way to diversify and kind of be able to play commodities as a whole. So we'll take a look at that too as we go through the charts. Why trade commodities? Well, here, don't also get confused between trading commodities and trading futures, because there are other types of futures like bond futures or stock index futures or currency futures, which aren't commodity futures. So generally when you trade commodities, you're trading futures markets, but again, the ETF market has developed enough to track several individual ones, and some certainly much more liquid than others. So for instance, GLD, which is the most liquid gold ETF, pretty much tracks the price of gold. SLV tracks the price of silver. And there's oil, which is like USO. But when you get into some of these non-metal commodity related ETFs, you have to understand really what you're trading. And although USO is the most commonly traded oil ETF, it doesn't track the front month of oil. It tracks way past 6 months and even goes close, if I remember, to a year out in oil. And a lot of times the front month doesn't move the same as the back months do. So you could be bullish oil and think oil's going up, and for some reason, let's say crude oil futures are up 3% in a day and USO is barely up at all, and you go, how could that be? It's supposed to track the price of oil. Well, again, this particular contract is not just the front month of oil, it's spread out across up to a year ahead, and therefore is not going to track the price of oil directly on a percentage basis. Generally, they move together, but not on a day in, day out basis. So you really have to know the specifics of the contracts that you're trading if you trade commodities. And again, they offer, if you trade commodity futures, they offer, often in the neighborhoods of 20-to-1 leverage. So there's lots of bang for your buck, but it works against you also. So read up on commodity futures and futures in general if you're going to trade them. If you stick purely with the ETFs, make sure you know what your ETF is actually tracking. So go to the homepage of whichever ETF you're considering trading and read the specifics to make sure you understand that GLD tracking gold much more closely tracks the price of front month gold than, let's say, USO tracks oil, or UNG tracks natural gas on a day in, day out basis. All right. Lots of resources on the web and books to read about commodities. I've been trading them. I got into commodities when I was trading. I was trading even in college. And my first summer job was on the floor of the Commodities Exchange. And that's how I ended up going into the industry and the career I did. So I've been trading them for, over 40 years, but there's a lot to learn about them. And again, don't walk into them blindly. If you do, you will likely lose your rear end, and you don't want to do that. You really need to understand what you're doing when you trade commodities, but they offer you a very good way of, if you're playing the correct direction and your timing is good, you can make a lot of money with them. And because these are actual real goods, right? There is copper, there is coffee, these are used globally. It's very different than purely speculating like you do if you're trading the cryptos. You don't see 20% moves in a commodity in a single day. You can certainly see 3% and 5% moves on certain days, but you're generally not going to see a 20% move and more like you can see in the crypto markets, which fundamentals are very difficult to determine. There is fundamental research by every major Wall Street firm on the commodity markets, especially the tier one firms all have research on the commodity side. So if you're clients of those firms, hopefully you can get access to those if you're interested in trading. All right, let's get to just a macro overview of the markets. We'll start with the Dow Jones. Everything we look at will be weekly charts. You can see we've gone basically sideways since July. We've got some exhaustion signals having shown up earlier this year, which eventually broke through, but we're kind of still sideways really almost since March, when they first started showing again the exhaustion signals being the DeMark 13s, possibly the 9s. And you can see that the most recent move down, we've got 1, 2, 3 weeks in a row, all bottomed into the most recent weekly TDST line. That's the lowest low of a 9 count up. That was this bar here, and 3 out of the last 4 weekly lows were there. But you can also notice that 1, 2, 3, 4, almost 5 weekly highs are in the same place here too, somewhere in and around 35,000. So we've got a trading range now from 35,000 to about 33,750. Whichever way we break will be the next near-term move. If we come lower, notice that you've got a couple of important trend lines just north of 33,000 and 32,800 or so is the propulsion level on the downside, which if it properly breaks would then suggest a much larger move down to under 30,000. But a lot of times during this bull market, these levels end up holding a support instead of initiating new sells. For instance, back here in November of last year, here is the bearish propulsion level, held it properly, ended up being the buy signal, not the sell signal. The fact that this is not so far away from where the cloud is over the next month and a half suggests to me that if we got down to near 33,000, you should start seeing some support again. I'm in the camp of that the mega bears out there, like the Mike Wilsons of Morgan Stanley, and I think it's Merrill, people looking for 15 and 20% declines from the high, I do not think we'll be satisfied. We're not satisfied, meaning we're not going to achieve those results. The mega bulls, who have targets up in the S&P at 4,700, etc., are not going to be satisfied this year either. I think we are in a trading range that likely lasts through the balance of the year, using the S&P as my proxy, and that you can see a few 100-point range up and down, but I think we're basically sideways for months to come. Let's also quickly look at the 10-year. So here's the US Treasury 10-year. This is in yield terms, it's the TNX. So if you move the decimal, you get the actual yield. So currently it's at 16.05, which is the same as 1.605 yield on the US 10-year. For those of you who have been watching this show for months, you know that when we got down here in the summer is when I turned quite bearish on the bond market. I told you that I personally sold out of virtually my entire portfolio of bonds, and yields have moved up quite a bit since then. We haven't hit the highs of the year at 176, but we're at 160 and close to some resistance at 164 or so. If we take out the highs, I look for 181 to 186, 187 or so to be next area of resistance and kind of where I expected we get to this year. So we fell short of it by 10 basis points or so. We'll see if we get follow through after this makes the 9 count next week. But I do think that bond yields are done on the downside. Like I had said, they bottomed in general into the Fibonacci retracement box from what was the all-time low to this year's high, but we timed it perfectly off of the 9 count And that's where, you know, we made the biggest move. And then let's take a look at the GSG. Let's see, did I put this in here? I did not. So let's get rid of, just get rid of this. We'll do GSG. So here's the Goldman Sachs Commodity Index. I want to bring in a little more time in here, even go back farther. So you can see that price up here now at 17.5-ish is up into the range where we've peaked in 2018. And that was the highest level since 2015. Notice that the bottoms here in 2015 is pretty much exactly where we topped in 2018, and we're close to again. So if we can get above 19 and kind of hold there, then you get a major breakout in commodities to the upside. In the meantime, there is going to be resistance anywhere in the GSG from, let's just say, anywhere near current price up through 19. If you've been long commodities for a while, then as we continue to rally in here, and we've got a new aggressive sequential 13 from, looks like last week, it's not crazy to use this rally to lighten up, and you can always put it back on if we break out over 19. What you don't want to do is necessarily do nothing into this rally if you're long, and then sit and hope that the market breaks out above 19, which it may very well do. But to me, if I'm long and I've got good profits in here, nothing wrong with taking some profits and then putting it back on if it breaks out if you need to. We're already on a 12 count too on a standard sequential. So in a week or two, we could easily get a standard sequential 13. So, you know, my theory is if we know we're against long-term resistance and a major inflection point, which is kind of in the 1880 level, then as we get there, take some off. If it goes down, you can always put some on. If you can put it back on, if you know, continue to like commodities. But if you do nothing and we fall down, and then you say to yourself, why did I do nothing? Why was I so greedy not to take some profits after a major bull run and know my level at what, you know, where the breakout is? You know, that's the way I trade. You may, you know, trade differently. When I'm up against resistance, and I've got some exhaustion signals, I take some profits. I'm not saying to take all profits and be out of everything, but I'm saying in general, nothing wrong with taking some. If you get a pullback down back to support, you put it back on. If it breaks out to the upside, you put it back on. But doing nothing to me is kind of the worst thing, because if it falls and you've done nothing, you feel like a fool. And that's never a good thing when you're trading. So that's my thought on the GSG. The CRB index is going to be a little different because it's more weighted on the energy side. So it's going to be even stronger looking because energy has been such a big mover to the upside, especially with virtually $80 oil and natural gas that's at multi-year highs. And we'll take a look at those on an individual basis, but that's my feeling in a general sense. Let's take a look at, here's gold now. So we'll try to get through as many of these as we can. This is gold futures. This is a rolling basis. So every time a contract expires, it just attaches the next contract onto it. It's kind of the closest look to what gold looks like in the spot market, but using the futures markets. And we peaked last August into kind of a 13.9 top. And we sold down to a 9 down. Again, for those of you who don't know what that is, that's a pattern that Tom DeMark noticed of it's 9 consecutive weeks that the close on each weekend, meaning Friday, or whatever the last day of the week is less than the close from 4 weeks prior. That's often a near-term turning point. Did it the same here, 1 week before the high was made. In May this year, was 9 consecutive weeks that the close was above the close from 4 weeks prior. That got you the interim high. We then sold off and tested the lows here. And gold's, you know, just in this massive consolidation phase. We're underneath the 50-week moving average. We're still well above the 200-week. I would say looking at the lows here, here, and here. You really don't want to see gold break under 1675 or so, because that would bring you down to the 200-week moving average in all likelihood. So I think it can, it can ill afford to get under 1675 at this point. And for those gold bulls, you really kind of want to see this level hold in. Next big level on the upside would be about 1850. Not so far away from some of these prior tops, but it's having trouble. You can see it's having trouble getting through the 50-week moving average. So I've been holding on to gold. Then I'm long from well lower levels, but I lightened a little, but I'm still holding. But I'm certainly very cognizant of this 1675 level. Let's look at silver. Silver actually made a spike high this year in February, but it came on a 13 count, basically at the same level as the highs were last summer, which was on a weekly 9 count. Then we got another 13 here. So you've got, kind of a triple top, all with exhaustive signals. We've sold down to the bottom of the cloud here for the last month. The bottom of the weekly cloud keeps holding. Get a couple of closes underneath it. You open the likelihood of breaking under $20 silver and testing that 200-week moving average all the way down to about $18, where the most recent weekly TDST line is. So this kind of really needs to hold in here too. I'll give one interim level, which is 20.77, where the cloud's lagging line would hit the bottom of its cloud. Otherwise, silver's in a sideways pattern. You can go all the way back to here and see we've got 1, 2, 3, 4, kind of 5 lows. This is really kind of an important level that it needs to hold. Copper. Now, by the way, there are standard symbols for futures, but this particular charting system I'm on doesn't use the standard symbol. So copper is normally HG. But although in this CQG it's CP. Here's a look at copper. Most importantly, after peaking on an aggressive sequential 13, and why we continue to use this model is that it often helps call highs and lows better than any other model I know. We've held the 50-week moving average, which is very close to a 200-day moving average on the pullback. You've got cloud support here. I still like copper over time. It hasn't broken out from, let's see, maybe, no, there's the downtrend. We're kind of right on the downtrend from the highs. We've got important lows here. So you've got a descending triangle, generally a continuation pattern. If this breaks out to the upside, next level, big level is up all the way at 517. So I generally like copper, but it is caught right now and hasn't quite broken out of this most recent pattern. Platinum, typically PL is the ticker, and it's not, you can't use a stock ticker. Almost every charting system uses some designation to indicate that it's a futures contract. On CQG that I'm using, you actually type F dot and then PL, and that would get you Platinum futures. On StockCharts, I think it's a $sign that's used. And so you will notice that you can't just use a standard 2-letter symbol. You need something to designate it as a futures contract. Here's platinum, recently bottomed at a fairly flat 200-week moving average. MACD getting closer to crossing bullishly, isn't quite there yet. Also, double topped, not last summer the way the silver and well, certainly gold did, but this double top this year, the second one on a 13. So if we hold here, that's good. If we don't, we get down to like the mid 800s. So I'm kind of counting on this holding in here and just looking for entry to potentially play another leg higher. The dollar is going to have a factor on all these metals. The higher the dollar goes and it keeps going up, the worse it is for these metals. Crude oil, standard symbol CL. Weekly 13 here. Now, when you have a strong bull market like we've had, you'll see multiple 13s. The only one we would have purely played possibly was this one. Here's one that's at least cautioning me. Now, I've got targets from about 81.5 to 85.5 in oil. So I think it's late in the rally I'm looking to, as we get here, I'm actually starting to lighten up a little bit on my exposure to oil and oil-related ETFs like XOP and OIH and things that I have that, relate to oil. So I'll use now strength, probably not much more to be reducing exposure than going heavily into adding more. Here's a crazy one for you: natural gas. The price in the US has exploded. We don't really have supply issues, but a lot of the move is both technically related, as well as the fact that Europe, and we're not generally exporting our natural gas to Europe. They get their most flow coming from Russia, and Russia had pipeline issues and withheld natural gas into the continent, into the European continent, and that's why the price has gone crazy. And a lot of times you're going to see a correlation, even though they're not directly related. But the price of natural gas has moved significantly higher globally, and the US has too. Notice though that recently we got some 13s here. We're getting closer to some type of exhaustion, at least near term. But I also noticed that this is perfectly climbed up the cloud's pink line, which is the conversion line, the shortest of the moving averages in cloud. So as long as we're above that, you could get in a consolidation. You don't necessarily have to have a pullback. If you do, I'd look for 476 level and kind of 456, so somewhere in the mid to upper fours as the next level of support. But if you trade natural gas, you want to have been on the long side up until very recently, and this is a very, very big move. And also, even the individual daily moves have been wild in natural gas. This is not for the faint of heart. Corn. Here's the corn market. It topped on a 9 count. The 13 came just a couple weeks before it, and you wouldn't have taken till minimally somewhere in here. Notice we're just tucking beneath the 50-week moving average, but we do have cloud support here. So it's been in a trading range for the last few months. It's gone nowhere. If you get spike move down to 480, that would be my buy point that I'd be very comfortable at. Otherwise, in here, you just kind of trade the range. Wheat and corn usually, by the way, is just the letter C. Wheat is W. Okay, what's going on here? See, even I'm trying to remember my signals, or this is, it's not. I'll come back to wheat because I don't remember the ticker. Here's soybeans. Soybeans on a weekly 9 down, just beneath propulsion exhaustion level. So it's either going to hold right in here or come down to the bottom of the cloud. If it takes a couple of weeks, bottom cloud moves up. If you're, possibly the beginning of a place to take a look at exposure there. Oh, that little noise means we are out of time. So we didn't get to a couple of the other ones. I'm going to finish on MOO. MOO is an ETF that tracks agricultural commodities specifically. So it doesn't have oil or anything. It's just agricultural. And it's had a huge move up. We've gone sideways for months. If this gets above 96.5 or so, then look for 99 and 104. If it pulls back, look for support near the 50-week moving average in the top of the cloud. That's it for this week. I hope you enjoyed our little intake into the commodity markets. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.